All right, so this is the second video talking about the statement of cash flows. So make sure you already watched that first one. In the first one, we talked about the three classifications, which was operating, investing, and financing. So that's where all of our cash movement is going to fall under on the statement of cash flows. We talked about why it was important as well. So if you didn't catch that video, make sure you watch it first and understand all of that. So in this video, we're going to talk about how to actually create the statement of cash flows. Honestly, it's a lot of understanding the concepts. It's not that it's super hard once you get it, but make sure you're paying close attention, no distractions, try to make sure you're nice and awake. I know it's hard to watch an accounting video when you're all comfy on the couch without getting a little dozy, right? So get some caffeine and listen to how we create this. So we talked about the different classifications, but also there's going to be some transactions that happen that do not include cash. Instead, they have to do with investing and financing. So maybe you retire debt and you issue equity stock at the same time. So that would be non-cash. One of the biggest things you're going to see here is this one right here, purchase of long-term assets. So maybe we buy a machine by issuing a note. Okay, so I bought this $100,000 machine, but I didn't pay any cash for it yet. Instead, I had this notes payable for the full 100,000. No cash moved around in that. Instead, it affected investing because we got the machine. That's something we invested in. And it affects financing because we financed the whole thing. So in this case, there's no cash changing hands at this point, but it does affect both of those portions, both those classifications. So you can look at the other ones there, but that's going to be one of the main ones that you see happen in the non-cash section. So this is what the statement of cash flows looks like. You're going to have the company's name, statement of cash flows, and then it's going to be from one period to the other. It's going to be a time period just like the income statement, right? Not like the balance sheet where it's one moment in time, but it's going to be a time range. From this time to this time, this is what happened with our cash accounts. What am I saying? So the first thing you're going to see is the operating activities. As I said, you're usually going to see the longest list of transactions under operating activities. Then you'll list out the investing activities, then the financing activities. Then you will bring the net of those to show the net increase or decrease in cash. We do hope this is an increase. We always want to have cash coming in. But as I said in the last video, it doesn't necessarily mean it's a bad thing if one or two of these categories have a negative. That's not necessarily bad. And then we're going to show the balance at the beginning of the year. And then when you add those together, hoping they're both positive numbers, that will show our current cash that we have on hand. So in order to prepare the statement of cash flows, you're going to have the balance sheet, not just for this year, but for 2 years. So the comparative balance sheet. So the end of last year, which is the same as our beginning balances, and the end of the current year, if we're doing it for the whole year. And then you're going to want the current income statement. And then there's also going to be additional information that you're going to have to consider. So when you have to actually work out problems, you have to create it yourself, you are going to see all three of these things. The comparative balance sheet. See, we have the end of 2020 and the end of 2021. So it shows, and this one, it conveniently shows the change, the increase or decrease in each account. We have the current income statement. And then there's additional information that we need in order to create this. So honestly, if you can, I would suggest that you print off this slide so you can kind of follow along as I cover this information, because it would be really good to have this in front of you as we reference back to each of these things. If I get to see you in person, I like to hand out a printed copy of this, but if not, maybe pause it and print it yourself. So there are two different methods, the indirect and direct method. So the one that we're really going to cover in this chapter is the indirect method. So in this case, what we do is we start out with the net income or net loss, if that happens to be the case. But we're going to start out. So at the bottom of the income statement, let's go ahead and go back to the other slide. In the income statement at the bottom, the net income was $38,000. So we're going to start with that. And then we're going to work our way back to figure out what our cash actually was. Because remember, just because we had sales doesn't mean we got all that in cash. Just because we had expenses doesn't mean that we paid for all of that during this period. We might have some money in accounts receivable because we received cash. We're going to receive cash later on from those sales, or we might see some money in accounts payable because we owe later on, and there's some other things to consider as well. So the first portion, and we're going to walk through this very step by step, but the first portion is adjustments from the income statement that did not affect cash. The number one thing you're going to see on this is depreciation expense. So what is depreciation expense? I bought an asset a while back and I'm using it. I paid cash for it or accounts payable or something for it a long time ago. But as I use it, I show depreciation expense. Did depreciation expense affect cash at all? No. Every line item we have to think about it. How did this actually affect cash? Depreciation expense does not affect cash. Yes, we get to show it as an expense to lower our net income so we can show that big purchase of the asset over time, but depreciation expense has nothing to do with cash. So we're going to take our net income, and if you see a positive number, we're adding back that $24,000 in depreciation expense. If we look back at our income statement, then we have depreciation expense of $24,000, but that did not affect cash. So we're going to add that back. That did not decrease our cash. So we've got net income plus our depreciation expense. We're going to add that back in there. That's cash we still have. Then the loss and gain of assets or notes, we're going to talk about those. We'll talk about those in great detail and why we're either going to add back that loss or subtract that gain, because those are going to show up in a different section. So we'll come back to that in the other slides. Then we're going to look at the balance sheet, the comparative balance sheet, and see the increases and decreases in assets and liabilities and look at how that might have affected cash. So that's where we're going with this. All right, so let's look at that first little section I told you about that includes transactions that show up on the income statement but do not affect cash. So I told you the first one was depreciation expense, and we walked through why that was the case, why it doesn't affect cash. So we added that back because there was no cash leaving, even though it was an expense. We're going to dig in even more to loss and gain in just a few slides, but I'll go ahead and briefly talk about those. So if we sell an asset and we sold it for less than what we had as the book value, we report a loss on the income statement, right? So we had it as one amount, we sold it for less, so there's a loss. But did that loss actually result in us giving money away? No. We showed whenever we first purchased it, we showed how much we paid for it, and we showed when we sell it how much we received. We don't actually need to show that loss on the cash flow statement because there isn't any cash going out. Even though we did lose money, we didn't give money away. Same thing for the gain. We're going to look at this exact transaction later, but maybe we received an extra amount of money. Maybe we received a discount on a notes payable. Well, that's great, but that doesn't mean we need to show extra money coming in. We're going to show the total we got. And if we show the gain on top of it, it's going to kind of double it. So we'll see this more as we go along. If it's not making sense, don't stress out about it. We're going to cover that more in a minute. This little table here is really helpful. It's another thing you might want to print out and have on hand as you go through your assignments. Hopefully you can really grasp why we do each of these things, but it doesn't hurt to have a little template to reference back to either. So these are when we have changes in the assets, the current assets and current liabilities on the comparative balance sheet. So this shows if it's a current asset and it increases from last year to this year, we're going to subtract it from net income. So an example of this would be accounts receivable. That's a current asset. If accounts receivable goes up from one year to the other, that's sales that we made that we showed in net income, but we have not received as much cash for it yet. So we need to subtract it from our actual cash. If it increases, so if accounts receivable, if it decreases, if accounts receivable went down from one year to the other, then that means we received more cash than what we're even showing in sales. So people paid off from previous purchases from previous time periods. So we would add that to what our net income was to get to our cash balance. And it's just the opposite for current liabilities. If it's accounts payable, which is going to be the main current liability you run into, if it increases from one year to the next, then we are going to show that, hey, we didn't pay as much as our expenses say. We haven't actually given that cash out yet. Our accounts payable was $100,000, now it's $105,000. That means $5,000 of the expenses has not actually been paid out yet in cash. But if it's gone down, if the current liability has decreased, then it means just the opposite, and we'll subtract it from net income. So again, as we go through the transactions, I want you to really understand the concepts, but this is a nice little way to check yourself and see if you've got it down pat. So this is the portion where it shows us the changes in current assets and liabilities. So we, like that chart shows us, if there's an increase in accounts receivable, that's less cash that we've actually received at this point. So we're going to subtract that from what our net income number was to get to our cash number. Increase in inventory, we also subtract. That means that we must have purchased more inventory. So we had cash going out for that. Increase in prepaid expenses. So that means we actually paid more cash than what our expenses were in that case. And so we have more cash going out. Then the opposite for current liabilities, there was a decrease in accounts payable. We paid off some of our accounts payable, so we must have sent out more cash than what our expenses were. A decrease in interest payable, the same idea. We had some payable on there maybe last year, and now we paid off extra. Then we have an increase in income tax payable for $10,000. That means we showed an income tax expense, but we haven't paid all of that in cash yet. So let's add that back to show that cash hasn't left our bank account yet. So here just kind of shows that summary of what it's going to look like when we put those things together, those adjustments from non-cash expenses and the gains and losses, and then the adjustments from the current assets and current liabilities. So that's just kind of showing what it would look like together. Then, so all of that was in the operating activities. So what about the investing activities? So we are going to walk through the different steps of the investing activities for transactions that happen for this company. So one investing activity, we see that last year we had $210,000 in plant assets. Now we have $250,000. So not all of your comparative balance sheets will do this, but this one goes ahead and calculates it for you. There was a $40,000 increase. So this shows us that there was a $40,000 increase to plant assets. And we also can see that there was a $12,000 increase in accumulated depreciation right below here. So what does this mean? Well, we're also going to have, remember that additional information section? We had the comparative balance sheet, the income statement, and then the additional information. Well, here's the different items that fall under that additional information that we're going to need to consider. Like, what exactly is going on here? So we look at item B, and it says Genesis purchased plant assets of $60,000 by issuing a $60,000 note payable. Okay, so we increased our assets by $60,000, but we also increased our notes payable by $60,000. Do you remember what we called that? That was the non-cash transaction between investing and financing. Yeah, we had both of those increase, but neither one of them actually had cash go out. So we're just going to have that in kind of a note after the statement of cash flows. Item C tells us that Genesis sold plant assets that cost them $20,000, and they had $12,000 of accumulated depreciation. They sold it for $2,000 cash. That resulted in a $6,000 loss. So here, these journal entries, we are not making these entries now. we are reconstructing them. We're saying, okay, if this was the situation, this would have been the entry that would have been made. So in item C, this is what the entry would have been. We sold assets that cost us $20,000. So we're going to credit plant assets, get that off the books. They had $12,000 of accumulated depreciation, which would have been a credit balance. We need to debit that to get that off the books. And we received cash for $2,000 for those. And if we have to balance it out, we see the difference is $6,000 loss. As you can see, the only thing here that actually touches cash is the $2,000. So ultimately, I do care for my income statement and for my profit and everything, whether or not I had a loss, and it stinks that I did. But for the statement of cash flows, I don't care. It doesn't matter to me what I paid for it. It doesn't matter to me what the accumulated depreciation was. It doesn't matter to me if it was a gain or loss. All I care about for the statement of cash flows is how much I had come in or go out in cash. So again, it does matter for your business as a whole, but when creating this, we can leave all of that off. We don't need to show that loss as cash going out. No cash actually left for that. We just want to show how much we sold it for. And you're going to see some examples of that in your homework. And we also look and see what the depreciation expense would have been. And it would have been $24,000. We saw that in a previous slide, $24,000 of depreciation expense. And the other side of that would have been a credit to accumulated depreciation. But again, it doesn't touch cash. So we don't need to show that as a decrease to cash. So we add that back to net income. So this here just kind of pulls all that information together. I know this looks like a lot, but don't panic. It's just showing everything coming in and going out of plant assets, the beginning and ending balance, and how it got there. And the same thing for accumulated depreciation. But ultimately, we see that the only thing that touched cash in all of this was the $2,000 that we received. And then that $60,000 was a non-cash investing and financing activity. So we'll just put that on the notes. Then we come down to the financing activities. So what do we do? How our steps work with our financing activities? We want to identify any changes in any accounts that have to do with financing. Then we want to recreate the T accounts and the journal entries to see what would have been booked for that. And then we are going to report that on the statement of cash flows. So in this case, we have a long-term notes payable. That's definitely a financing activity. And again, it tells us real handy here. It went from $64,000 to $90,000. So we had a $26,000 increase. So we look at any notes that have to do with it. And in this one, the additional note E tells us that notes with carrying value of $34,000 are retired for $18,000 cash, resulting in a $16,000 gain. So let me tell you what's happening here. This company owed $34,000, but I guess, it'd been a while, and the people who were to receive that cash, that principal payoff, said, look, just give us $18,000 and we'll call it even. We'll call it the debt is done. So they're like, sweet, let's do that. We'll give you $18,000 in cash. We'll write off our whole $34,000 notes payable. And that really results in a gain for us of $16,000, which is so exciting and fantastic, but does not need to be reflected on the statement of cash flows. The only thing in this transaction, we got rid of our notes payable. We show a gain, but the only thing we care about is what touched cash, which was the $18,000. So the only thing we're actually going to put in our financing activities is the $18,000. We showed this gain on the income statement, but that was not cash coming in. So remember, we had to subtract that $16,000 out on the statement of cash flows to show that, hey, we didn't actually get cash for that. It was great, but has nothing to do with the statement of cash flows. So let's see. Oh, so common stock here. Yeah, so if we issue common stock, that also has to do with financing, right? It's not just loans, it's whenever we issue stock, common or preferred. So in this case, and you're going to see a homework problem that asks you very similar things to this. But first you want to analyze what happened. So they had an increase from common stock. It went from 80,000 to 95,000. So it was a $15,000 increase. And then we see an explanation in item D on the additional information that says that 3,000 shares of common stock are sold for $5 per share. Well, 3,000 times $5 is 15,000. So that's where it came from. So we issued an additional $15,000 worth of stock. So now we're going to report that change. Let's think about how that would have been in a journal entry. We would have shown cash come in of 15,000. We care about cash, that's important. And we show common stock increase by 15. Then we reconstruct that T account. We started with 80. We added 15. We ended with 95, all of which is a credit balance because we're increasing our common stock. We're increasing an equity account. So yes, that 15,000 did touch cash. It was cash coming in under financing activities. So we're going to make sure that we do reflect that. And then we get down to retained earnings. So retained earnings starts out with what we had in there before, our beginning balance, which was 88,000. But we see that it increased to 112,000. Okay, so what do we know from this? Even if it did not give us step 2 and tell us that cash dividends were paid, because you're going to have a homework problem that does not tell you that, we need to figure out how much dividends would be. So what we're going to do is take our beginning balance of 88. We're going to add the net income, which it gave us, of 38,000. And then we see our ending balance of 212. Well, that doesn't add up. So the only thing that would be different is if we paid some dividends. So the difference between what these two total and the ending balance is going to be what we paid in dividends. And in this example, it also tells us what the dividends are. But again, you'll see them without it like that. So what we actually paid in cash here was dividends of 14,000. So we want to subtract that. And since we are paying dividends on common stock that we issued, that's going to fall under the financing activities. I know that was a lot, but we take all of that information. This is everything we talked about, starting with the net income and then adding back the depreciation and then adding back the loss and subtracting the gain because none of this actually had cash moving around. Then we take the assets and liabilities with all the changes considered, and we can use that little chart for it. So that resulted in $20,000 cash provided, so cash coming in for operating activities. Then we sold a plant asset for $2,000, even though there was a loss. That's not what we care about on the statement of cash flows. So that's the only thing that happened in investing activities. So we had cash come in as $2,000. We didn't make an investment there. We sold a previous investment, but that's fine. It still falls under investing activities. And then we had the cash flows from financing activities. We saw that we issued 15,000 in stock. We paid 18,000 to retire those notes payable. That's okay for it to be a negative. That's a good thing. We paid off some debt and we actually had a gain in that as well, didn't we? And we paid out, so we have negative cash of 14 for dividends. So when you total those up, the net is going to be negative 17,000, but that's not necessarily a bad thing. We got rid of some debt in there. So we're going to total all of these up. The net of operating, investing, and financing activities is a $5,000 increase in cash. Sweet. And then we're going to add that to our prior year balance of 12,000. So that means our current balance should be 17,000. That should match what the current cash balance is at that point. So hopefully that brought some light to the statement of cash flows to you. I did also record and post a video walking you through a few of the homework problems so that I can hopefully get you started and be successful in that. But please reach out if you have any questions. I'm always happy to answer those for you.